makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Investors navigating a barrage of headlines from tech, tariffs, and, of course, the Fed. Upbeat earnings from Meta and Microsoft have bolstered optimism over resilient corporate profits. Now, in trade news, President Trump has unleashed a series of tariff deals and demands on the eve of his Friday deadline, including surprises on India and copper. Now, over at the Fed, the chair, Jay Powell, has shrugged off pressure from the White House and rejected arguments for an interest rate cut from two dissenting officials. Well, joining us to make sense of it all, Nadia, head of global equities at BNP Paribas Asset Management, our tech reporter, Mark Burden, and Jill Deeses in Hong Kong. There's a lot to get through. Mark, it's all about tech. Why are we liking tech so much? Is it that they're actually spending, hard cash on AI and data centers?
Yeah, in the case of Meta and Microsoft, I think the investor response here is that they're willing to spend in part because their core businesses are doing so well, right? I think we should be careful not to confuse. I saw an analyst note this morning that said this is unprecedented AI demand. Yes and no. I think, in Microsoft's case, this is their cloud business is doing tremendously well, and they're able to keep this spending on what they expect to be a future in AI sales, but we haven't seen evidence of that yet. In Meta's case, it's an ads business, right? They are basically a duopoly with Google. Their ads business is printing money, and then it's allowing them to invest very heavily in this future, which Mark Zuckerberg sees around superintelligence and AI.
Yeah, and Nadia, I guess this is also largely, when you look at tariffs and trade, and we'll get to some of the surprises that we got, it seems that tech put Tesla to one side, but certainly the Mag 7 are doing pretty well.
Oh, absolutely. And they've kind of been able to avoid some of the potential hit from tariffs. So when you've seen earnings coming down from the beginning of the year for all other sectors, tech is the only sector that has been actually earnings upgrade because it's more service-based, more secluded from that.
Jill, talk us through the latest tariff rates on South Korea and India. And again, this is ahead of that deadline. That's tomorrow, August 1st, Friday. And we had quite a lot of news coming from the White House.
Yes, that's right, Francine. So I think a couple of things to really look at here. Obviously, a pretty favorable rate for South Korea. First of all, that 15%. I think what you're seeing there is a template that we already experienced with Japan, which got a really similar 15% rate with some of those, sort of tariffs moved over for autos in particular. And then there's an investment amount that's kind of rolled up in there. Trump seems to have really liked over the past couple of weeks getting these countries to pledge to invest, something to the tune of hundreds of billions of dollars in the U.S. And then, he ultimately gets to choose that for whatever investment purposes he kind of wants. That seems to be how he's negotiating some of these deals. And so I think what you've really seen, particularly over the last couple of weeks, is countries kind of emerge in, I think what, Lutnick and others, his Commerce Secretary and others have kind of described as these buckets where maybe you put, the EU, South Korea, Japan in a 15% bucket. You see Southeast Asia, a lot of those nations are in this more like 19-20% bucket. But India, I think India is the really big surprise here because, wow, they really got walloped there with that 25% rate relative to some of these other places. And I think, one that's a really big blow to, the Indian Prime Minister Modi, because he was one of the first ones to go out to the White House and really kind of make an appeal, toward the start of the year on trying to get something negotiated here. Instead, what ends up happening is he gets, sort of a slap on the wrist here with this 25% tariff. And then Trump really kind of going on a tirade about how India buys, Russian energy, oil. Obviously not new news there, but certainly something that's rankled Trump as he's trying to get this, Ukraine-Russia war deal with Putin over the line. And so I think that's really kind of put India in a pretty bad spot here.
Yeah, and Joe, the other big story is, of course, copper, because President Trump effectively backed off on a lot of the copper tariffs, right? He threatened 50% tariff was only on semi-finished copper, not ores and concentrates. So that saves a large chunk of copper.
Well, Francine, I would point to copper as being a pretty big cautionary tale here. Look, a lot of these trade deals that we've seen from Trump, they exist in the form of conversations or Truth Social posts or something like that. We haven't seen a whole lot of white papers here. And I think it really shows you that, tariff deals, trade deals are often really complicated to negotiate. And all we really heard on copper before, this latest thing on how he was exempting the refined metals. So really, as you alluded to earlier, that's kind of like, the linchpin of international trade here. All we really knew news that, he wanted to apply tariffs on copper. Obviously, we saw a lot of stockpiling, ahead of then trying to get copper over to the U.S. because traders were really scared of what was going to happen with copper tariffs coming into effect. Well, finally, you get some details from Donald Trump. He says that he's ultimately exempting the most critical part, of that copper trade, that refined metal. I think it really just shows you that when it comes to some of these trade deals, it's really unpredictable. And ultimately, until you actually get that written down on a white paper with detailed plans on how exactly all this is going to work, it's really, really, really difficult to navigate the entirety of global trade around it. So, there you go. I think we'll obviously see what happens from there. But really, really difficult, to tell what's really on Trump's mind sometimes.
Yeah, this is the problem with investors, is that there's just so much uncertainty and it could reverse quite quickly. Mark, China also summoned some Nvidia representatives over alleged security risks in its H20 AI chips. What more do we know? Yeah,
it's a big roller coaster on this story. I mean, we just recently saw the news where Nvidia is now getting this permits license from the U.S. administration to sell its H20 chips. These are not its highest end, but the ones they've specifically made for the Chinese market. Now, Chinese officials from our reporting are saying that there is a potential security flaw, basically a backdoor, where the U.S. government would have access to data from Nvidia chips. And Nvidia has denied this. But this seems to be a signal that this is not like smooth sailing for Nvidia to return into China and see its prior sales. Of course, the context here is that especially Huawei and some of their competitors have been advancing pretty quickly. And there are Chinese rivals to Nvidia, I'd say, in a way that there probably isn't in other countries.
Nadia, when you put all of this together, how difficult is it to navigate for investors, the trade and tariffs? And is that why, by and large, they seem to be ignoring it, to just, touch record on record?
I think you're correct that it's extremely difficult to navigate. And that's why for us, it's really a case of understanding each business model individually, because depending on whether you have manufacturing footprint in the US or whether you don't, depending on how your supply chain is organized, you'll get very different outcome from the current tariff. And then, as you say, it's ever changing anyway. So the market has been shrugging off some of that. But it's also true that economic news and earnings so far have been extremely strong. So the impact has yet to be seen in terms of earnings. We're still expecting, I think, mid to high single-digit earnings growth in the U.S., which is extremely good when you think about the scare that we had early April. So probably the market could price more of a tail risk, but at the same time, I think you do have an upside surprise on the economic front and the earnings front so far.
Nadia, I also want to ask you about the Fed, because the chair, Jay Powell, says interest rates are in the right place to manage the risks around tariffs and inflation, really tempering expectations for a U.S. rate cut in September. Notably, Governors Christopher Waller and Mickey Bowman voted against the FOMC's decision to hold rates. Now, in his news conference, Powell lent into the view that the Fed is well positioned for now.
If you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market.
Let's bring in Valerie Teitel. Val, how hawkishly did the market perceive the press conference?
The press conference was quite hawkish from Jerome Powell. He lent in, as you heard there, on the strength of the labor market. They still characterize it as solid, despite the warnings from Governor Chris Waller, who thinks it's on edge, was one of the main reasons why he likely dissented in this decision. Powell went on and on to say that the risk to inflation, the fact that inflation remains elevated, really does warrant monetary policy staying where it is, staying moderately restrictive. So we did see two-year yields rise around 7 basis points over the course of the press conference. And perhaps most importantly for global investors, the dollar, again, on a winning streak. Yesterday was one of its best sessions of the year, rising nearly 1% in the session. It is on a 7-day winning streak, its longest winning streak since February, up almost 2%, really putting into a lot of doubt this dollar declines. Whether that was just the first half move and the second half is going to be a lot different for the U.S. dollar. When it came to those dissenters, yes, we had 2 Fed governors dissenting, something we've not seen in over 30 years. Governor Chris Waller, who set out his dissenting opinion essentially right before the blackout period, was joined by Governor Mickey Bowman. Powell did say in his press conference that he expects these two to release a dissenting opinion detailing why they voted to reduce interest rates at yesterday's meeting. It was very interesting to see both of their rationales.
Yeah, I hear a lot saying, if you read the second quarter GDP report that then landed a few hours before the committee's decision was announced, you might conclude that they were probably right. Valerie, thank you so much. Valerie Teitel. Nadia, when you look at, first of all, the economic growth in the U.S., it's slowing down. I mean, we saw some wild swings because of imports and inventories, making the headline growth pretty much illegible. But if you look at final domestic sales, there's still some points of weakness. Nothing huge, but it's weakening.
Oh, totally. And we're absolutely expecting a slowdown in H2. And it's about the magnitude of that slowdown and the effect it's going to have for us on the earnings stream and how much of a surprise will it be, because most well, I think consensus estimate are for a marked slowdown in the second quarter. And at the moment, what we're watching is really on the consumer side. How is it holding up? Commentaries that we've had from earnings from the financials were pretty supportive so far. So yes, we're expecting the slowdown. We think it's priced in. And so unless you have a big downside surprise, I don't think it's a big hurdle from here.
Yeah, so when you look at your equity picks, I mean, how much does it have to do with consumer spending? Again, you look at spending, it accelerated a touch from the first quarter, but it's actually, comparative to last year, it's gone down.
Yes. So that's why when we look at company, we really look at companies that have strong secular growth, that can really, companies that can grow organically. So we really like the tech sector. We like the financial sector there. What we've heard from this quarter is that actually you have a bit of a renewal of the animal spirit. We thought it was lost. And so I'm sure you've seen we have started the month with quite a lot of M&A announcement. It's really picking up. And so we pick the spaces where we think the sectors, the themes where we think you really have a good outlook. So defense, I think earlier on was mentioned, has also been a fantastic a theme to be exposed from a secular standpoint, as well as we continue to really very much like tech. And we think that earlier on this year, when it was lagging, we thought that was not justified. We really liked what we saw in the first quarter earnings on the spending side and on the top line acceleration. And I think this quarter is really a confirmation that that AI spending is starting to see benefit, and they're able to accelerate their growth on the top line. So the ROE, on that investment is really coming through, and that's also obviously really good for the semiconductor sector. So still areas that you can where you can see a lot of growth from a stock picking standpoint.
So Mark, by and large, are the Mag 7, apart from maybe again Tesla, are they largely immune to consumer spending right now?
That's a good question. I mean, I think that they obviously are operating largely different businesses. I mean, Amazon certainly isn't. And you look at on the tech side, Apple isn't. Google and Facebook are very much driven by consumer trends, but they all have these really pretty sizable market positions and moats, is what they, in the industry term, right? Like that even we're seeing Google probably is most vulnerable because of the rise of ChatGPT and a lot of this new search competition hasn't seemed to hit their earnings at all, right? They're still performing. They're still outperforming the market. They're still growing on all cylinders. And we're seeing this cloud business, like earlier conversation about Microsoft, that is a huge secular trend, right? A lot of that is just companies moving from on-premise storage to the cloud, and all the estimates suggest that's going to continue to grow.
What are you expecting the Fed to do, Nadia?
As an equity analyst, I'm just looking at the consensus. So I see the consensus was expecting a few rate cuts this year. It looks as though September now is more 50-50. From an equity standpoint, the companies that we like have strong balance sheet. They're not as dependent on rates. So I think so far it's proven that although interest rates are quite high, it hasn't put a dent on the economic growth. So yeah, we're fine with the rate outlook. I think my company has our macroeconomics teams as a view for no rate cuts this year.
Okay. Thank you all I mean, we did a lot in those 15 minutes. We covered all of the news for the week. Nadia Grant, Head of Global Equities at BNP Paribas Asset Management, Bloomberg's Jill Deeses, and Mark Bergen. Now, Mark is also the author of today's Big Take about an award-winning entrepreneur who brought the first big boost to the AI boom. It's a great read. We'll also push it out on social media, how an entrepreneur of the year brought the first big bust to the AI boom. It's today's Big Take. We'll also push it out, of course, on social media. You can find it on the terminal. Coming up, the boss of Knighthead Capital Management plans a £3 billion investment to build a new sports quarter in the UK city of Birmingham. We'll talk to Tom Wagner next, and this is Bloomberg. Well, ever since he bought the English football team Birmingham City, Tom Wagner has been building his investments in sports. The co-founder of Knighthead Capital Management has committed £3 billion to transform part of the city into a new sports quarter and purchase the Birmingham Phoenix cricket team. Now, Tom Wagner from Knighthead Capital Management is with me now. Tom, thank you so much for joining us. It's really exciting having you on the Pulse. You're really in the space where everybody wants to be in. I mean, suddenly it's like, it's fun, I imagine, but it's also an investment opportunity. Why the UK and why football?
That's a great question. We spent quite a bit of time researching English football before making our commitment to Birmingham City. And a lot of that was grounded in the principle that success in football is oftentimes connected to your success off the pitch and growing commercial revenue. And we felt in the case of Birmingham, it was a unique opportunity with a very, very large club in a city that frankly had been underinvested in for a long period of time to pursue something that was pretty novel and to take a club, out of the shadows and into the limelight by investing in the club directly, investing in the club indirectly through an infrastructure project. And candidly, all of that was too compelling given the UK's commitment to high-speed rail infrastructure that would serve the city and specifically our project.
Have you asked for government support for the stadium redevelopment?
So not directly. What we asked for were transport links that actually had been sought by East Birmingham for quite a period of time. So improving infrastructure in a train station at Adderley Park, and more importantly, creating tram lines that would lead from the center of the city out to the neighborhood where we're building our project, which had been underserved and led to, I think, or contributed to the fact that it is a deprived community, one that is in desperate need of investment, desperate need of jobs training, all of which will come as a result of our project. So while we're not asking for any direct government support, that indirect support through transport, I think, will really help make things happen.
Has the government been forthcoming?
Very much so. We began talking to them last fall, and in June, Rachel Reeves was kind enough to visit our stadium and announce a £2.4 billion infrastructure investment into Birmingham and the West Midlands that will really connect the center of the city, our site, the airport. And if you couple that with the ongoing investment in HS2, which we're confident will happen, it really creates a site that will be one of the most connected as it relates to stadium and entertainment projects in all of Western Europe.
You think it'll happen, which is news in itself. How quickly do you think it'll happen?
We hope to get planning over the course of the next 12 to 18 months, and then we'll go from there. So I would say that our objective is to have the stadium open in the 30-31 season. We've been pretty adamant in articulating that as our timeline. And I think that lines up well, from the perspective of where all these different elements of the project can come together, both transport, our investment, and then from there, it continues to grow. Our site is more than just a stadium. It's a stadium, arena. There'll be a smaller venue for the women's side until we grow fan support enough to put them in the larger stadium. And all of the training grounds for men's first team, women's first team, our academy, and then we've got housing, hotel, and office space as well. That's
quite an offering that you want to put in place. Tom, talk to me about other opportunities in the UK. So also, there's cricket, but there's just much more investment appetite, especially from American capital coming into the UK.
Yeah, I think we've seen, as a result of some of the policy changes, some capital has left the UK, some professionals have left the UK. I would hope that American investors will fill that void. We're beginning to see that with inbound investment into some housing in London specifically. But I think as it relates to the UK as a whole, there's a great opportunity to find ways to put capital to work. We've got 3 or 4 different projects that we're pursuing at the moment in the UK, all of which are very compelling to us, are extremely exciting. And I think it's consistent with our mandate. Sometimes we run to opportunities where others are perhaps looking the other way.
Give me a flavor of what you're looking at.
Yes, so we've got two, in addition to this project, we've got a real estate development project that we're pursuing in the south, which will be more high-end. That one I think is pretty exciting. We've got a race team investment here. We've got 3 sport investments here, and so three beyond the race team. So, it's a good number of opportunities. And I think one of the things that we find compelling is that there are certain sub-industries here that are world-class. Football, world-class. F1 and other race teams, our endurance racing team at Jota, world-class. And so when you find world-class industries within a particular market, it's a good place to go and look for opportunity.
Tom, do you think American capital or American owners will change, actually, the sports industry in the UK?
Yeah, I think, as is the case with most sport, it's transitioning from family ownership to institutional ownership in many cases. Not entirely, but in many cases you're seeing that. And what's happening with the institutional ownership is there's an increased focus on growing the commercial side of the business and really increasing the inbound connectivity between the B2B connectivity between a sports team and other businesses, and to grow revenues that way, as opposed to simply raising ticket prices or charging more for your pint on match day. And I think that professionalism is something that we'll see continue, and that should bring increased investment, more infrastructure investment, more stadium builds, which will hopefully lead to greater worldwide publicity.
Tom, I speak to a lot of chief executives, and they say it's always their childhood dream or even their now dream to own a football club. What's been your best and worst surprise?
Oh boy, that's a great question. I think the worst moment was April and into May of 2024 as we went through the process of experiencing relegation. And I'd be foolish to say that wasn't a great learning experience, and a difficult one at that. I think the best part of this is to see just how important the club is to the local community. It's much deeper connection than most other sports because, unlike the U.S. where you've got 4 or more major sports going on at various points in time throughout the year, with football you begin in August. You really begin in July as everyone ramps up for the transfer window and the beginning of training. But season begins in August and it runs through May, and it's just part and parcel of people's lives that entire time. And it's extremely important. And what it led us to understand is that we're not the owners of the club. We're the caretakers. The owners are the supporters.
Okay, Tom, thank you so much for joining us. Tom Wagner there, chairman of Birmingham City and co-founder of Knighthead Capital Management. Coming up, a clutch of banks have posted earnings that beat expectations. We'll bring you all the details next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Mag 7 momentum, Meta and Microsoft surge pre-market, boosting sentiment on a busy day for earnings. Trade surprises, U.S. copper collapses as President Trump exempts refined products from tariffs, while also announcing rates for India and South Korea. Plus, double dissent at the Fed, rates on hold, but 2 committee members voted for a cut. Now, Standard Chartered has announced a fresh $1.3 billion share buyback as the bank reported second quarter earnings that beat expectations. Bill Winters, the chief executive of Standard Chartered, told us the bank is significantly increasing its profits.
This is a bank that's growing its operating earnings in reasonably substantial double digits. We've been growing it at 20 or 25% for some time now in terms of our underlying earnings. And I think that can go for some time, based on the investments that we've been making for years. That should come through to our stock price over time. So I don't get too obsessively focused on the stock price day to day, but of course I'm happier at 1370 or wherever we are, rather than 6 when I used a bad word to describe our share price.
Well, let's bring in Jenny Serrain, who leads our finance team in the UK and the Middle East. Jenny, thank you so much for joining us. So Bill Winters are very clearly saying actually every part of the business is booming. What do we know?
It's interesting because they really did join in with the rest of Wall Street in terms of benefiting from all the volatility wrought by Donald Trump's trade war. So I think heading into the quarter, there was a lot of questions from investors about, if Donald Trump actually succeeds in, suppressing trade and really winning on this America First agenda, is that going to be bad news for a bank like Standard Chartered that is involved in a lot of cross-border flow? But what we really heard from them today was even if, the U.S. takes a step back and then maybe reduces some of its trading with certain partners, you see all those partners kind of rushing to trade with each other. And so in the end, it seems like it's really still benefiting them. They have a trading business. It's also actually benefited massively from the volatility. Wealthy people are still looking to put their money to work. So this was a solid quarter all around, and they're really firing on all cylinders.
I mean, there are a lot of earnings out there. Crédit Agricole, Société Générale in France, both beating expectations as well.
Yeah, no, absolutely. So it was sort of interesting that you really saw the Europeans coming in strong after the strong showing we saw just a few weeks ago from these U.S. banks. And so I think now the kind of question is this the chance for the Europeans to finally gain share and kind of remake themselves in the form of a JP Morgan, a Citigroup, a Bank of America? And you see them really putting up a strong fight here. So it's interesting. We've heard a lot from these banks this quarter about as the American banks, as they're working with clients here in Europe, these clients, maybe want to work more with European banks because they don't want to be seen only aligning with U.S. banks. So I think there's lots of tailwinds here for the whole sector.
Is there anything? I mean, I know we're still on M&A watch. The UK, that's a different story for some of the banks. But is there another main takeaway that you're looking at?
I think it was interesting because Bill Winters, in the conversation with us this morning, he did note that a lot of clients are still on hold. So we still haven't quite seen that full resurgence of M&A, that full doubling down on investment that everybody thought we'd see coming into the year. But he still seemed hopeful that there was a chance that would come back. As volatility has subsided, people have a little bit more visibility on these tariffs now. They're feeling better. They want to get back in the game. These banks are excited to kind of take advantage of that.
So interesting. Jenny, thank you so much. Jenny Serene there, who leads our finance team in the UK and the Middle East. Now, Swiss specialty chemicals maker Clariant has reported a better-than-expected second quarter operating profit. The company says despite economic uncertainties, it remains committed to delivering its medium-term targets. Well, joining us now is Conrad Keijzer, the chief executive of Clariant. Thank you so much, Mr. Keijzer, for being with us. Now, we have this deal between the U.S. and the EU, at least 15%, of course, of tariffs. How does it affect your decisions when it comes to investment, but also hiring, pricing, and supply chain management?
Yeah, good morning, Francine. In terms of the trade deal, how it affects us, we have done calculations on our revenue and what it means in terms of total tariffs that we're paying right now. On an annualized basis for the company, that is roughly 25 million euros of impact in terms of tariffs. Now, what we see is the company has a very global footprint with 68 sites globally. In the United States, for example, we make 70% of our sales locally. And for the 30% that we import, we do not have really local competition. So these are unique technologies in our catalyst business, in our additive business. So we're working with our customers to pass on these tariffs ultimately to the U.S. consumer. So on balance of this 25 million impact on margins, we do not expect that in the EBITDA line because we will offset it through pricing.
So it doesn't look like you have to trim your guidance, actually, to reflect this new uncertain environment.
Yeah, if you look at our guidance, we maintain our profitability outlook for 17 to 18% EBITDA margins for the year. We have revised down slightly our revenue guide. We were guiding before for a 3 to 5% growth in local currency. Now we said it's going to be a 1 to 3% growth in local currency because there is an impact on our customers. There's clearly a slowing of consumer spending on durable goods. And we saw that already if you look the comparison from quarter one to quarter two. And we will continue to see that in the remainder of the year. We do guide for 1 to 3% growth in local currency. That impacts also and that reflects also above market growth that we can achieve through the two new plants that we will start up in China in November.
I mean, is there a concern that actually some of the, that this hurts demand going forward if there's more uncertainty for a longer period of time? There does seem to be a belief in the markets that, maybe we're over the worst of the uncertainty, but it could come back in a couple of months.
Yeah, what you see, bigger picture is everybody was hoping this year for a shift back in overall GDP from services GDP to a bigger component of industrial GDP. So coming out of COVID, we saw a lot of spending, restaurants, vacations. GDP hold up well, but it was primarily spending on services. What we were actually expecting at the beginning of the year is this switch back to durable goods spending. That is actually delayed now. Durable goods, consumer goods are and will be impacted by tariffs. So there is actually a delayed recovery in this switch back in GDP to industrial GDP, which is in the end what the chemical industry needs.
Okay. Does it mean, I mean, is there anything that you have to change in terms of, the structure to simplify it, or do you have to give more back to shareholders in this kind of environment?
Yeah, we are pleased that what we show with our guidance of 17 to 18% EBITDA for the year, this reflects a strong improvement in profitability this year in a low or no growth environment. As a reminder, last year we had a full year EBITDA margin of 16%. In 2023, we had a full year EBITDA margin of 14.6%. So we basically saw 3 years of consecutive strong improvement in profitability, but it was very much driven by self-help. This is very much the cost out program that we finished in the first half, which took a total of 175 million Swiss francs out of our cost base. And that is actually a structural improvement that positions the company well to maintain high profitability levels, even step them up further in a low or no growth environment.
How are you dealing with currencies? How much do you have to hedge given the fluctuations and, again, the uncertainties?
In terms of currencies, we also benefit here from our global footprint, where basically 68 sites we produce typically in a region for a region, also based on local raw materials. So there is not a significant transaction impact from currency devaluation. But what we are seeing in the top line, but this is a translation effect, we report in Swiss francs. We are seeing an 8% effect from the strengthening of the Swiss franc. But again, on our EBITDA margins, this has virtually no impact because we have typically our cost base in the countries where we are supplying.
Is there anything else that you worry about going forward? For example, if you look at your catalyst business, what does that need? Are you seeing any turnaround? And when are you hoping to see the fruits of your work?
Yeah, the catalyst business, Francine, is very much linked to the chemical industry overall. What you see here is that we are bottoming out, but operating rates are still at a relatively low level. So if you look at the capacity utilization rates of plants in Europe, it is basically around 75% right now. If you look at the United States, it's around 80%. And in China, it is a very mixed picture. These are historically low operating rates, and we see the impact of that in our catalyst business. The outlook for the year for our catalyst business is basically flat revenue growth. We think we are bottoming out, but it is a challenging environment in catalysts right now. Therefore, also in catalysts, we were very pleased with the step up in profitability, despite some of the revenue headwinds, where now we are achieving a 22-23% EBITDA margin in the second quarter. Really also the effect of margin management, but also the effect of a structural lower cost base.
Are you committed to the catalyst business, or could you sell it off?
We are very committed to all of our businesses. They actually, right now, if you look at our numbers, all three of the business units are doing very well. And it is actually in catalyst where we have unique technology also that positions us very well for the green hydrogen economy. So we supply the catalysts that basically enable green ammonia, basically climate neutral shipping, when you replace bunker fuel with green ammonia. We are well positioned for the sustainability trends. And with our catalyst business, day in, day out, we lower the carbon footprint of our customers by enabling chemical processes at lower temperatures, at higher yields. So it also very much fits the purpose of our company, which is greater chemistry between people and planet. It's all about sustainability-driven growth.
Conrad, thank you for joining us. Conrad Keijzer there, the chief executive of Clariant. Now on to another industry, Renault, having reported an operating margin for the first time, or for the first half of the year, that missed the average estimate. Now analysts are now expecting a better second half as the French automaker appointed a company veteran as chief executive. Well, Bloomberg's Craig Trudell is with us. First of all, Craig, I mean, Luca de Meo didn't leave this in a great shape because there was quite a lot of, it was a difficult set of results.
Yeah, I think maybe this was a good time for him to look for the exits, in the sense that I think we should give him credit. He managed to turn this company from, I think in his words, he referred to this company as being in hell when he started out, to, on much more solid footing, and yet in the first half of this year, you did start to see some real slack in the performance. And I think it was only going to get more difficult, and is only going to get, sort of tougher sledding for European manufacturers in their home market, given the success that the Chinese manufacturers in particular are really starting to have serious traction, not just in the EV market, but as we've seen tariffs hit electric vehicles from the Chinese, some sort of, moving around those and offering up hybrids and even just out-and-out combustion cars that are gaining traction and squeezing the likes of Renault.
So the newly appointed chief executive definitely has his work cut out for him. I mean, he's a company man, so he's not an outsider. Like, what should be on his priority list? Yeah,
not quite a lifer, but a long timer, more than 20 years with the company. And knows sort of how to run the trains here. Was, I think, instrumental in forming a partnership with Geely that was quite interesting under de Meo, where you heard de Meo in the last year or so refer to that being sort of the new Renault-Nissan alliance, that Renault-Geely may be the sort of partnership that replaces that. I think his experience with that and with China operations and the China industry will be something really, for us to watch in terms of how much he's able to leverage that lower cost base in China to make Renault more competitive here.
Craig, BMW, what did we find out?
I think, this was a case of yet another company really squeezed by tariffs. You would think that they would maybe be somewhat better positioned than some of their peers, given the fact that their biggest plant in the world is in Spartanburg, South Carolina. And yet, I think this is something that we saw earlier this week as well with Stellantis, which has a fair number of U.S. plants. Even if you have a serious presence in the U.S., that plant needs parts from outside of the U.S. And so even that operation is being squeezed, and there's sort of nowhere to hide if you're in the auto industry from these tariffs.
Craig, thank you so much. You're my Musk guy. We speak about Elon Musk. I can't believe we're here talking about BMW and Renault. We'll have to get you back on to know what's happening with Tesla. Craig Trudell there, our global car czar. Now, from autos to aviation, and Airbus has reported a bigger than expected cash outflow as a shortage of engines hampered its ability to deliver aircraft. Now, the chief executive, Guillaume Faury, told us Airbus hopes to get deliveries back on track.
We have 60 aircraft sitting on the ground, fully finished, but with engines missing. We call them gliders. So if you look at what we've been able to produce, including the gliders, actually we are mostly on track with what we expected to do in the first half. So we count on engine makers, namely CFM and to a smaller extent Pratt, to recover on their engine deliveries to Airbus, so we can be back on track with a number of deliveries.
Meanwhile, Lufthansa says second quarter earnings rose by a third and reiterated its full year targets. Now, earnings growth was driven by strong demand on transatlantic routes and lower oil prices. Air France-KLM also reported higher second quarter earnings as a revamped business and first class product boosted yields. And Tata Steel has reported first quarter net income that beat estimates. The CEO says the Indian steelmaker is planning to explore alternative markets due to rising tariff risks. Well, TV Narendra spoke exclusively to Bloomberg.
So you would mitigate by looking at other products which are similarly profitable and other markets, whether in Europe or elsewhere. For instance, the Middle East is a growing market for some of these steels. So we're looking at Middle East, we're looking at Latin America as a market. So we're looking at other markets where there is a requirement for these high-end steels and where we are not impacted by these kind of tariffs.
TV Narendra also spoke about the impact of Chinese overcapacity on the global steel industry.
China was exporting more than 100 million tons of steel. And last year and this year as well, China's been exporting at the rate of 100 million tons of steel and more. That's a matter of concern because, steel industry is a global industry. A lot of steel flows across borders. Our concern is if the Chinese industry is not making much money but still exporting steel, that depresses the profitability of steel companies globally.
Well, that was the Tata Steel Chief Executive and Managing Director, TV Narendra. And coming up, pre-tax profits at the Weir Group rise 10% year on year as the engineering company reports positive results. Well, the Chief Executive, John Stanton, joins me next, and this is Bloomberg. Now, UK engineering company the Weir Group has reported adjusted pre-tax profits up 10% in the first half, ahead of average estimates. Joining us now, John Stanton, Chief Executive of the Weir Group. John, thank you so much, as always, for giving us a little bit of your time. So I have to ask about tariffs because, it's a day before the deadline, August 1st. That's tomorrow. How has the tariff uncertainty, first of all, impacted your decisions for investment, but also your pipeline and orders?
Yeah, well, good morning, Francine. Thanks for having me. Yeah, so it's been a complex 6 months in terms of having to deal with the tariff situation. Philosophically, we've approached it to say, first of all, we want to try and pass as little on to our customers as possible and use our capability to avoid doing that, but also to protect our margins. And we have the benefit of having a sort of global manufacturing footprint that's kind of regionally distributed. So we've been able to play lots of tunes across our network and supply chain to actually avoid things that we previously imported into the US and therefore the tariffs, and move them into other parts of the world in terms of where we're exporting to. So we did a lot of work through our network to enable that, which meant that we've avoided a lot of tariffs. And then the little bit of product that we had to bring into the US from China and Canada, then we have passed on price increases to our customers. But given all of the work that we've done to try and mitigate that for them, that's been an okay conversation in the circumstances. So I think in terms of those philosophical objectives, we've delivered on both of them for our customers and in terms of completely mitigating the effects for our profitability as well.
John, do you see any customers actually being hesitant? Because there's a lot, if you look at commodity prices, it's booming. You have quite a lot of demand for it. But are there any, customers saying, well, let's wait and see because they look at geopolitics and they're not quite sure what happens next?
Yeah, I mean, there's a little bit of that going on at the moment, but I think, the mining industry that we serve and that we have to be prepared to serve, it thinks really long term. So while there's kind of volatility in the world today and, movements in commodity prices, our customers are really thinking long term and making plans based on that. And therefore, I think even though there's been some uncertainty, it's been minimal. We're certainly moving ahead with our investment plans. If you take copper, for example, that's going to be a big growth driver for the mining industry, for the Weir Group over many, many years ahead. So we need to be ready now to take advantage of that. And I think there are actually some really encouraging signs in terms of government policy responses in the US, places like Chile, to say actually we need to free up some of the licensing, permitting, maybe the capital constraints that have meant that projects haven't been pushed forward very quickly, and that's improving.
Well, John, I mean, if you look at copper, I feel like all hell broke loose yesterday, and it was down, quite significantly in the US because what we thought would happen on tariffs actually didn't happen because part of them was exempt.
Yeah.
So again, between having a pipeline of customers and then orders, does that take longer?
No, I mean, again, I'm not really bothered about short-term volatility. When you look at copper prices today, they're still well above the average cost to produce, and they're in line with sort of long-term incentive levels. So you're going to see this volatility probably with tariffs and Western countries like the US figuring out how they're going to enable more supply of critical minerals within their own domestic production capacity and capability. So there's going to be uncertainty. There's people kind of making strategic moves. But the long run, I think it's really just short-term volatility. The long-run outlook for copper and many other commodities is really, really positive.
You mentioned copper. What about gold? Is there more, mining demand for gold? And is there anything else? I don't know whether lithium's on the rise.
Yeah, no, gold is clearly very positive at the moment for obvious reasons. So our customers who are the pure play gold miners are very busy, working really hard to try and increase production and productivity across their existing mines. So that's a really, really active space for us at the moment. Iron ore's been a little bit weaker, but then again, the high-grade iron ores, which are necessary for the energy transition, are moving ahead quite nicely. And then, when you look at the battery metals, we have been through a little bit of a correction over the last few months. Nickel in particular has been one that's been quite challenging. But given the global nature of our business, we kind of lose in countries like Australia, where they've been closing mines, but we're winning in Indonesia, where Chinese-funded expansion is still going ahead. So it's a bit of a wash for us. And that's the beauty of our business, being so diversified across commodities and across countries around the world.
I mean, have you seen any of your clients having to diversify some of the trade routes, or because it's so much, it takes so long actually for the mining to happen, it hasn't really affected your industry too much?
No, not really. The other good thing that's happening at the moment is that it has taken a long time for some of the big expansions and greenfield projects to come through. As I said, there's been some government response to that, which is quite encouraging. In the meantime, all the brownfield, all the existing mines around the world are just running really hard to try and keep up with production and demand. So we kind of win-win either way. We'd love some big new projects and expansions to come through, but if they don't, we're very happy delivering on the momentum that our current customers have in the mines around the world as they seek to expand production.
I mean, you're in a good place, but so what are you most excited about for the next 12 months, and what are you most worried about in the next 12 months?
I'm not worried about too much, because I think for Weir today, a lot of our future is in our hands. We feel really in control of the situation. The long run potential of the business is really, really exciting. And what's been great in the first half of this year is that, alongside strong results, we've really been able to deliver some significant strategic progress. We bought a big software company. We made some investment in technology. We're buying a manufacturing business in the US, which actually will give us more flexibility as it comes to tariffs and so on. So I think the strategic progress that we've made in the first half on top of the trading performance has been phenomenal. And I think you're going to see Weir do more of that over the next few years. We've got a strong balance sheet, and we'll be reinvesting in the business. Yeah, that's the plan.
More acquisitions in the US, or is it all in play depending on geopolitics?
We're focused on software and digital, product extensions, geographic expansion. So those are the three focus areas for us. We did one of each in the first half of the year, which was really nice. But we've got a good sort of playbook of assets that we'd like to have within our portfolio. So we'll be focusing on them as we move forward.
All right, John, thank you so much for coming on, as always. John Stanton, the chief executive there of the Weir Group. Now, we are looking at a lot of earnings. I have to say, it feels like it's a busy day also because of the added layer of tariffs. We were talking about copper with John, and look, the copper market really reeling from its biggest shock yet after Donald Trump imposed 50% tariffs on copper imports but exempted refined metals. So the move triggered a record plunge for U.S. prices. Copper futures on COMEX in New York falling by more than 22%, and a large premium from New York futures over London seemed to be evaporating. We talked to analysts at Goldman Sachs this morning saying they were surprised by the exemption, but added that they do not see it changing market fundamentals and don't expect large-scale re-exports from the U.S. Up next, Bloomberg Brief, and this is Bloomberg.